the speed at which Trump is moving, if we get some kind of hint at an accord being signed, well, all these question marks around Russian product supply are going to be coming front and center. Hello, welcome to Oil Insights. I'm your host, Harry Tchilinguirian, Group Head of Research at Onyx Capital, and today I'm joined by Onyx Research Associates Martha Dowding, Vincent Wu, and Mita Chaturvedi. Before we start the show, please like and subscribe to the podcast. I also invite you to visit Onyx's LinkedIn and YouTube channels for more interesting and exciting content. President Trump is on a roll with tariffs front and center of his agenda, thus the choice of my sweater today. Now, the U.S. has imposed a 25% tariff on all steel and aluminum imports with no exceptions, effective on the 4th of March. At the same time, President Trump has hinted at imposing tariffs on countries that go against his foreign policy objectives, with Jordan a recent case in point in relation to the plans that the president has for Palestinians while taking over the Gaza Strip. For all the hoopla around President Trump being a disruptive agent generating increased uncertainty, when you actually look at realized volatility of the price of Brent over a 30-day rolling average period, we are currently sub 25%, which for oil is pretty low. In the interim, implied volatility from option pricing has been showing a sizable premium to realized volatility, but realized volatility is not moving up in any hurry. So if the flat price traders are getting wrong-footed by Donald Trump, option traders are not faring much better. By going long volatility, they're just sitting watching their screens and paying theta for nothing. This week's macro environment was not a beat. Testifying in front of the U.S. Senate, Chair Jerome Powell said that the Fed was in no rush to lower policy rates on Tuesday. On Wednesday, the U.S. CPI prints came out and they exceeded market expectations, sending the S&P 500 lower and U.S. bond yields higher. You could imagine that Powell's message to the House Financial Committee was no different, even as Donald Trump called for lower interest rates on Truth Social. The rise of European natural gas prices was briefly on the oil market's radar this week, with some observers speculating on gas-to-liquid substitution in demand. However, the bullish impetus of this development appeared to be lost amidst U.S. weekly data showing U.S. crude stocks building a further 4 million barrels on top of the previous week's 9 million barrel increment. Finally, when it comes to geopolitics, yesterday, President Trump and President Putin initiated talks to end the war in Ukraine, and invitations were extended mutually for visits. Now, how quickly the news will permeate into risk premia to deflate the oil prices, well, we're getting a little bit of a sense of that today. The move in flat price, however, just following the news, was relatively muted, and the Brent spreads at the front don't really have much room to move lower from their current 30-cent backwardation. Now, in fundamentals, the OPEC Secretariat and the IEA released their monthly oil market reports this week, and OPEC is still optimistic about global oil demand growth at 1.4 million barrels per day year on year in 2025, and the IEA is sticking to a more conservative 1 million barrel a day, 1.1 million barrel a day. Now, the IEA continues to see a 500 kbd surplus roughly this year if OPEC production stays constant. Onyx's own view on global oil demand growth lands above or slightly above the IEA's at 1.1, a little bit more. And our current estimate of the surplus in 2025 is still at circa 1 million barrels per day. So in this week's podcast, we're not going to belabor the macroeconomic and geopolitical uncertainties generated by President Trump, who's moving full speed ahead. Instead, we're going to actually focus on price and what technical analysis says about short-term price direction in crude, U.S. gasoline, and gasoil. All I could say is that since the inauguration of President Trump on the 20th of January, Brent has been on a steady grind lower, with a front-month Brent contract currently trading at $74 a barrel or thereabouts at the time of this podcast, compared to roughly $80 at the close of his inauguration date. So before we turn to the technical indicators, we will review, as usual, the positioning of risk takers on the Brent futures contract. And for that, I'm going to be turning to Vincent Wu. So Vincent, as per usual, what are they doing?
Of course, so in Brent futures, there wasn't a whole lot of week-on-week changes. The week ending February 4th was a risk-off week for money managers. Both long and short positions declined by 5%. Still, a lot of length remains in Brent, as net positioning is still higher than levels from 2 weeks ago. And before that, that's still the highest level since May of 2024. But following on actually what Mita mentioned last week on the CDA positioning, where we saw a reduction in length from CDAs, this was reflected, but actually in WTI futures, money manager positioning. There was a lot of profit-taking flow. Long positions overall fell by 15% for 2 weeks in a row, while shorts increased by 50% in 2 weeks. So this is also reflected in the substantial widening of the WTI Brent spreads.
Okay. So I take it with the sort of more modest changes in long-short positioning on Brent futures, the long-short ratio is probably only just modestly gained relative to where we were before.
Yeah, so yeah, very modest change, still around the 4.3 to 1 long-short ratio. However, the combined Brent and WTI crude futures long-short in 2 weeks fell from the 66th percentile to the 43rd percentile for 4 weeks since 2013. So a bearish skew, and perhaps that's likely as tariff threats have spooked the market with expectations of high inflation, higher for longer interest rates, creating headwinds for oil consumption. But there's still a lot of bullish risk takers holding length in Brent. So because of the relative overcrowding, there's definitely potential for a further sell-off should more bearish catalysts materialize.
But I guess in terms of our latest, at least, commemorative traders data coming from ICE, coming from the CFTC, we're now in this holding pattern as of last Tuesday. Sorry. However, in between, of course, a lot of things happen. And turning to our CTAs, you already alluded to them, but have they been going in the other direction?
Yeah, so this week, CDA flows have been more balanced. So sellers were dominant until Monday, 10th of February, but this trend reversed until Wednesday, until the 12th, as that price rallied before selling resumed on Thursday. So we're on a net positioning basis from CTAs, we're pretty much at levels from the start of the year. So net position in Brent CDAs, currently we see it as minus 10,000 lots. And the 2024 average was minus 8,000 lots. So it's fair to assume that positioning at its current state is quite balanced. So a lot of capacity for CDAs to deploy in either direction, depending on market sentiment.
Well, I guess with all the uncertainty, they have their job cut up for them. It's not an easy environment to be going long or short flat price, because from one day to the other, obviously, there can be changes. And now that we have a geopolitical overlay with conversations that have been initiated between President Trump and Putin, that could have multiple repercussions for oil markets in terms of Russia's crude oil supply, its product exports, and many other things. So uncertain times, and yeah, positioning is going to be difficult. Now, we're going to turn to our technical analysis portion of the show, and this is going to be interesting because we're setting aside fundamentals, we're setting aside the whole environment, and we're just going to take the view, as technical analysts do, that all the information you need is in the price. So we're going to start off with Brent, and we're going to start off with Mita. And so, I mean, I mentioned at the beginning of the show, Brent has been on a steady grind lower since the inauguration day of President Trump. So what can you tell us about the technical indicators in Brent, the price action, and where possibly we could end up by the end of next week?
Yes. So as you said, Brent prices have been grinding lower since mid-January now, but this week actually saw a bit of support in price action, and in our technical analysis report on Monday, we said that we expect the front-month contract to test the $77 handle, where it would likely see more selling come in with like as we approach this resistance level, which is exactly what happened. The front-month Brent futures saw more support, as I mentioned, and we jumped from a close of under $75 on 7th Feb to a high of $77.30 per barrel on 11th Feb. However, the M1 contract fell significantly after this and is currently around $74.50. So the contract, just looking at moving averages, the contract closed above the 10-day moving average, which is currently at 75.40, which was significant because this breached a pretty substantial resistance level that we've been seeing since around 20th January. But this essentially meant nothing because the contract fell again below this level the next day.
Yeah.
We're also now flirting with the 100-day structural moving average, which is a significant support to have surpassed. And if we have to see if we close below this level by this week, that'll be pretty significant. It'll be pretty significant bearish indicator. Other support levels to look out for are $74, which was previously tested at around 6th Feb, and $73, which is currently the lower Bollinger Band level. Longer term support may be found around $71 to $72, which successfully saw support around the end of December.
So those were kind of the sort of equilibrium levels in terms of pricing we had in Q4 of last year.
Yes, exactly. Should the contract see strength, I would expect it to find resistance at, well, the 10-day moving average still remains as a pretty significant resistance level, but also the 20-day moving average, which coincidentally now is at 77, which was where we saw resistance.
So we're
this
targeting
week.
As well.
Exactly, which we were targeting at the start of the week. Sorry, a final point on moving averages that I will say is that the 10-day moving average has slipped just below the 50-day moving average. And it'd be important to keep an eye on whether this holds by the end of today and by tomorrow as well, just to look out for a possible bearish moving average crossover at the end of the week.
I guess it'll be important to see by how much we move by the end of today, and whether over the next couple of days that crossover is indeed confirmed before coming out and targeting lower. But it is an interesting turnaround. How's momentum looking in terms of the market?
Momentum indicators were showing a short-term retracement upwards, but that was until Wednesday when we saw a pretty significant sell-off in Brent futures. On Monday, the 1066 stochastic oscillator saw the faster oscillator rise above the slower line, but this dropped on Wednesday. This was yesterday. It dropped below the slower oscillator, and now we see the faster line moving at a further discount to the slower line, which is a bearish indicator of momentum. The 14-day RSI also moved from an uptick to a complete decline in convergence with how price action has been, which again shows that the fact that we didn't see a divergence there is also just shows that the support that we saw on Monday was short-lived, and we are likely just continuing with the bearishness that we saw.
No, we're not seeing any discrepancy between RSI and price movement, especially with the last day.
Exactly.
So the tone is sounding bearish on momentum.
The tone is sounding bearish, especially with the RSI still in neutral territory and following prices. So we'll have to see how prices close today as well. But it isn't looking too bullish, especially with volatility indicators like the Bollinger Band is also narrowing, indicating a decline in volatility. Such a decline usually follows an outburst in volatility, leading to a breakout on either side. But now with prices moving towards the lower Bollinger Band as well, it'd be important to see if we close outside the Bollinger Band and continue to decline. That would be something I would look out for.
Well, that would certainly be very strong downward momentum, because when prices do start traveling a little outside the Bollinger Band, then typically they do come in. But in terms of more generic chart patterns, I don't think there's any particular chart pattern that has been emerging, right? In the case of Brent, so are we seeing any reversals in terms of the latest price action when we start looking at this from like a candle perspective? How did the formations, over the last couple of days, and especially yesterday's close, any particular signals we could glean from those?
For sure. As you said, we haven't really seen any discernible patterns from price action alone. But another reason why I'm not bullish anymore, or just have been, I think we might go on this bearish decline that we're seeing right now is because of daily candlesticks. So daily candlesticks showed some support from the end of last week, so from Friday to around Tuesday. But Wednesday saw a pretty bearish signal. We saw a bearish Mariposa line, and not only that, it also went beyond. It started similarly to the previous day's close, but it ended beyond the previous 2 days close.
I'm looking at the chart now, and
Yes.
that's a pretty significant solid body candle.
Very similar to how bearish engulfing pattern looks like. So we are currently on track to completely shedding the gains we have seen since the end of last week. And if that happens, that's a pretty significant retracement downwards. In my
I guess on
opinion.
the chart today that we have in the podcast, the latest candle is today's price action.
Yes,
Yeah. So that's not looking too good to
exactly.
start off with. So maybe there is indeed room to start testing the resistances the support lines that you mentioned earlier.
I mean, anything we've learned this week is that anything could happen towards the end of the day. That we started yesterday pretty supported, but then midday everything, like we saw that bearish Mariposa candle. So I guess we still have to wait till the end of the week to make a proper judgment of what's happening candlesticks wise. But the fact that yesterday's candlestick movement was not a great sign for what's to come.
So given, this obviously looking at technical analysis, we're looking at a daily chart. So, we were at 74 this morning or thereabout. In 1 week's time, you feel that we're going to be testing lower, and then if I look at the chart, we're now talking what, 72, 73?
Yes, that's exactly where I'd put it actually. I think in a week from now we could be testing 72. I do think we'll see support at this level, similar to how we did at the end of Q4 last year. But I do target ICE Brent to reach 72 by next week.
Okay, so we got a bearish skew from a technical perspective on crude prices. So turning to products, we're going to, in this week's show, we're going to focus on European gas oil. And for that, I'm going to be turning to Martha Dowding. So Martha, price action, has that been reflective of the more broader pessimistic mood that we could assign to distillates in general related to the economy, industrial output, freight, and of course tariff uncertainties that weigh on these? So all these are sentiment aspects to what could drive prices. But what has gas oil been doing?
So there was some support seen last month in the middle distillate complex. The most important kind of things happening all kind of happened in the States. So there were the tariffs that you mentioned were kind of building up, tensions about kind of supply and demand issues. And on top of that, there was the part closure of the Colonial Pipeline, and also the forecast kind of disbelief, and then the occurrence of the cold snap, which reached down to Texas, which was a big increase in heating oil demand, and we saw the HOGOs kind of rally a lot. But that also led to a rally in European gas oil, and as a complex was lifted by this tightness in the States. So looking to the inauguration and the tariffs, as you mentioned, after the speech delaying the tariffs, we saw the February-June spread, which opened at about 42 and $3/4 per metric ton on the day of the speech, and that fell to lows of $18.75 a metric ton towards the end of the month. So there were really heavy losses in gas oil, and that did kind of combine with the pricing out of the cold freeze, the pricing out of the Arctic freeze, and the kind of worries of winter, and kind of the forecast of a more normal winter kind of straight after that. And in Europe, there's not been really any good news about industrial production. We've got some really poor stats out of Germany specifically.
So can we identify at least some level of support in sort of this sort of downward type momentum? Do we have at least is the market eyeing some level of, let's say, perhaps either psychological or support leaning more on longer term moving averages? So where would be a sort of decent floor for this market?
So it's kind of a combination of the both. We by no means are in complete free fall right now. So just this morning we were trading at about $705 per ton. And I think under that, the really important support levels, in my opinion, would be the 50-day moving average primarily, which we have seen cross kind of be alongside tend to the $700 per metric ton psychological level. So during last week and a bit prior to that, we have seen this really kind of stagnant price action, kind of trading, hitting the 700-day/50-day moving average, $700, sorry.
Yeah, $700 ton.
50-day moving average, and bouncing back. And this morning, we're still yet to break that $50 moving average with any kind of meaningful momentum. So I think that would be the first thing to get, the most important to pass, and then below that, 700, and then below that, the 100-day moving average has been quite a good point of resistance looking to kind of Q4.
Yeah, I'm looking at the chart, and of course, a lot of yesterday's price action, was sort of cross crude and products. the sort of deflationary impact on prices in general and energy from the announcements of this is the beginning of talks between Putin and Trump. That certainly affects things. But I just on the chart basis, yeah, it seemed to have a solid ground. But momentum-wise, it just seems iffy, right? There's no particularly strong momentum really developing
I
in
mean,
terms of price action.
so looking at the stochastics of the market, the slower line has passed over the faster line, which is kind of a bearish crossover, but we are in the neutral territory. So there is increased selling pressure or maybe just weakening bullish momentum. We would need to keep an eye on this to see if we are going into the oversold levels, which would be kind of warning of a downtrend. And on looking at the other momentum indicators, the MACD histogram is negative, and as you can imagine, this dropped yesterday, but it's still at less negative levels than we had seen earlier in the month. So that shows that the momentum, bearish momentum, has some room for improvement. And lastly, the 14-day RSI is facing down, but it is some distance away from oversold territory. So we are kind of in no man's land in terms of momentum, but just by looking at the MACD, there is some bearish momentum in the market.
So yeah, I guess the MACD is still, the histogram is still showing us that the momentum is negative, although albeit, the strength of that momentum has considerably diminished. So with modest momentum, and of course we had retracement in prices yesterday, and we're sitting on the support. Can we get any information in terms of how CTAs are acting? Because they often trade on technical indicators, and whether they're staying put, adding to length or shortening length, could also give us an indication of maybe which way gasoil is going to go.
Yeah, I think we're seeing the impact of that sideways trading in Q4 kind of creating lots of false signals in the moving averages, making them almost flat, because the CTA net positioning has kind of been oscillating around zero. So we saw it go positive to negative last week, and then this week it rose from below minus 4,000 lots on the 7th to about, well, let's round up to about positive 7,000 lots today. This is far from the highs seen in January, and kind of looks more to kind of like a normalization of kind of unsurety moving around zero, where we do see these really big moves in CTA positioning drive the market, but also they're not at extremes all of the time, and that's what we're seeing in gasoil right now.
So it is kind of interesting because there's an element of wait and see, and that element I think is going to take on even greater importance now that talks are being initiated around the end of a war in Ukraine, because the implications now, this may not change the way Russia behaves in the context of the OPEC Plus group, but if we do have some kind of resolution, the end to the war, and the U.S. were to lift tariffs on Russia, does the EU follow? And then suddenly you're faced with the prospect of a lot of gasoil coming back into Europe. You're faced with a prospect with a lot of VGO coming back. And so from a sentiment point of view, and if the price here is supposed to incorporate all the information, because the speed at which Trump is moving, if we get some kind of hint at an accord being signed, well, all these question marks around Russian product supply are going to be coming front and center. So maybe from a sentiment and then momentum, momentum gets moving again as a result.
I think that's kind of echoed in the technical aspects of the chart as well, as we can see that as prices turned yesterday, we saw the Bollinger Bands narrow quite significantly, showing that volatility is decreasing and the market is happy to kind of enter this bearish phase.
Okay, so from gas oil to gasoline. Vincent, we're going to be looking at U.S. gasoline today.
Yes.
And so I'm just a little bit curious in terms of if the complex, and there's a lot of co-movement, we said in the past couple of days, which sort of makes it tricky to isolate the technical trends for a specific underlying. But I mean, if we were to look at how gasoline has been behaving, is there anything we could take from technical signals?
Yeah, sure. So if anything, it's a sideways market right now. Although let's look at the support and resistance first of all with the price action. So the front month RBOB futures initially bounced off the 9-day moving average at the start of the week, but on Wednesday closed below that level. So The immediate resistance levels are the $2.17 per gallon mark, which is the year-to-date highs, but also corresponds with the Fibonacci, the 38% Fibonacci retracement. That was from the July highs to the December lows. As our viewers might recall, the big sell-off from since at the end of last year.
So those two levels have seen convergence, yeah?
Yes,
Fibonacci
exactly.
retracement, previous peak high.
Yes.
Relatively solid two-way validation of that.
So the main support level I see is the 50-day moving average, as marked on the thick blue line in the charts. So that's at the $2.03 level, which is also where late January lows kind of bounced off, where it's shown by the lower end of the shadows on those candlesticks. So if RBOB was to continue its downwards trend, we would expect to see levels being tested at that region.
$2.03, yeah. And I noticed that that level is also sort of commensurate with the lower end of the Bollinger Band too. So it could be definitely a point where we're going to maybe face some hesitation before we can move lower. Are we finding, like in gas oil, and product complex seems to have far less in the momentum indicators, or far less signal in the momentum indicators in terms of one way or the other than what we've seen in crude oil? So are we finding the same when we start looking at RSIs and MACDs on gasoline? Are we going anywhere?
In simple terms, we are not going anywhere. It was a change from the what we analysed from the technical reports from Monday. We're going in a neutral and range-bound direction. So the positive MACD histogram was quite short-lived, and the RSI has become neutral at 50. And the market in its current state is quite hesitant, with Onyx, the CDA model, indicating neutral positioning in RBOB, where net positioning is around flat, around zero. But if anything, the indicators point towards a bearish divergence, which is between price action and the RSI. So, which implies a potentially weaker uptrend this time compared to the previous rally, where previously RSI reached the overbought level, but around a similar price action, similar highs. Now the RSI, the peak was lower at 60.
Okay. So the RSI is not turning downwards, yet we have prices going downwards. So in terms of bearish divergence signals, I suppose that's as good as any. So at the end of the day, so what are we currently trading at this morning? We were at what, $2.08, right?
Yeah, $2.06.
So I guess, to sum it up, we have a sort of bearish skew. So what that takes the targets maybe by next week hitting the resistance of $2.03 as a first step kind of thing.
Yes, so that would be testing the testing $2.03. That would be at the 50-day moving average.
Okay. So in terms of us going over, and there's so much more we could obviously do with technical analysis, and we could spend hours talking about this. But at the end of the day, so we're aiming at $2.03 a gallon on RBOB in a week's time. We're aiming at 77 Brent, right? Where are we waiting? Sorry. Excuse me, that was our previous target. Yes, we're aiming lower at 72-ish, and we're, in terms of gas oil, we're looking at the support level of $700 metric ton as holding, right? So that kind of sort of sums up our technical views a week ahead, which now allows us to sort of move to our crystal ball moment, which is a whole different ball game in terms of giving our impressions, combining this kind of analysis, the broader macro environment, new geopolitical environment that's unfolding very fast. And every time I always used to ask this question, 80 or 70. Now, of course, the price has taken us down to 74, but by the end of this quarter, is that 70 mark looking a lot better than what it was maybe 2 weeks ago? So, Martha, what's your take?
Yeah, I think it is. I think it's always been looking quite good, but I think we've got a week of consolidation maybe on our hands. I think it depends when the negotiations happen and how they go. I think it's fingers crossed, likely that we're going to get some kind of peace out of this, and I think there could be room to the downside here. I think there's been a lot of geopolitical risk built in over the time that this has been happening, and in the meantime, we could see this tense risk-off market being the main focus happening. I think tariffs are delayed, that could flare up, but right now the Russia-Ukraine piece is the most important thing, the most focused on thing in the markets. The only thing I could think, other than some crazy event, we do have another Arctic blast coming in the States this week, but it is due to reach Texas, so that could damage infrastructure. So that's just something to keep an eye on the upside, but I think we've got room on the downside.
So, Mita?
I agree with Martha. I think, as I've mentioned at this with the technical analysis as well, I am bearish right now for the next week. And as for the end of Q1, I do agree that with how the geopolitical climate is quickly unfolding, I do see room to the downside, which if hopefully we get a peace deal out of this. Other than that, with tariffs, there's so much that's still not clear with tariffs, and even with the maximum pressure on Iran, we established in our previous episode that that's not likely to, like, a U.S. sanction will not impact Iranian supply as much this time around. And then with OPEC supply plan to come back as well around Q2, I don't see a lot of upside this time around, especially with refinery maintenance also scheduled for like second quarter of this year. I don't see a lot of upside for crude right now.
Less crude demand, more supply, uncertainty around tariffs. So I let Vincent for last specifically because he is our perma bull, and I just wanted to know how long your horns are right now.
Well, the horns are slightly shorter this week. I'll mention a few reasons for that. So Brent's kind of at a crossroads here. The physical market health isn't looking too great, as indicated by a negative front Brent futures fly. So April, May, June, that's at around minus 10 cents. From a sentiment perspective, January is usually a bullish month. People like to be long, but then there was a perfect cocktail of fundamental events that was quite bullish for the market, but then $80 was really quickly sold into. So now we're back at around 75 Brent positions, as mentioned earlier, still a bit overcrowded to the long side. So all it takes is another bearish catalyst, for example, with OPEC confirming bring barrels back to the market, or more developments in peace negotiations. That's really, these are bearish headwinds for oil prices. But going towards the end of Q1, perhaps the bearish news could be offset by potentially Iranian sanctions or on Venezuela, as well as rising tensions in the Middle East perspective as well, Gaza.
So would that put you more in holding the line on 75, which you had, I think, last time around, rather than low 70s or 70 itself? Would that be an accurate description?
Yeah, sure. Holding the line, 75.
Holding the bullish line at 75. I guess, from my point of view, everything we said, there's always different elements that come into play, and depending on what you want to emphasize and how certain actors will behave. We know that there's always a lot of opportunistic Chinese buying when oil prices are low, and we've seen that happen last year. We went to the low 70s. China came in, bought a lot of crude. Doesn't necessarily mean that they're going to be refining a lot of crude, but they are price sensitive, and if there is a bargain to be had, they will be stocking up. So that could be one element in terms of preventing the market from moving too far below. Another thing I noticed, we've been commenting on this show and in our publications about whether or not Trump is bearish for oil prices, and we've said this even before I think his election, or maybe I may be exaggerating there, but at least we have mentioned this early on. And so right now that is proving to be the case. Now, whether or not he decides to apply maximum pressure on Iran, or that was just a simple negotiating technique in order to get a quick resolution on a nuclear deal. Who knows? We'll see. But obviously, there's a lot going out there that, in my view, is going to certainly give food for thought in terms of OPEC plus decision makers. So Martha was mentioning a return of OPEC barrels scheduled for April. The OPEC Secretariat's monthly oil market report came out, still relatively constructive on global oil demand growth at plus 1.4 million barrels a day year on year for 2025. They have a more conservative view on oil supply outside of the Declaration of Cooperation countries, or the OPEC plus group. So that kind of lays the foundation for a return of voluntary cut barrels. But at the end of the day, if the price is low, I think that's going to override any fundamental projection. If the price is at 70, they will hold. So if they hold, then of course that lends a little bit into the more bullish skew. A little bit of this, a little bit of that. My view is that we reestablished the equilibrium levels we had back in at the end of last year. But then again, depending on how fast things move, it wouldn't be surprising that the market tests this, at least in my opinion, a 60 handle. Not saying it's necessarily going to stay in that area, but our global oil balance, as of today, still shows near 1 million barrel a day implied build in global oil inventories. Granted, that's coming off a very low inventory base in 2024, so we're not like calling for the curve to flip into to contango or anything, but that element is there as well. So I think 70s with the potential testing of a 60s handle before again renewed demand for crude as it's viewed as being particularly cheap. So there we have it, low 70s, 75, and maybe an outlier view of testing by the end of the quarter a 60 handle before getting back into the 70s. So I guess with that, that concludes the podcast. Thank you everyone for joining us today. Until our next episode, and as usual, don't forget to smash that like button or slap it, whatever way you like. And please subscribe to our podcasts and those of Onyx on the World of Oil Derivatives. So we'll see you next week. Thank you very much. Thank you, guys.